So we move to chapter 6, absorption costing and marginal costing. Now I can tell you this is definitely one of the go-to chapters in this course. There will absolutely 1000% certainty be questions on these two costing methods in your exam. So let's make sure that we understand the basics, but also the calculations. I think that's what the examiner is more than likely going to target. Let's look at the first area first, and it pertains to this concept of contribution. Now this is important, particularly when we look at marginal costing. So what do we mean? It may be something that you've come across before. This concept, in essence, in terms of a definition, basically means the difference between the product or service selling price and the marginal cost. And for marginal cost, we can broadly refer to variable cost. So we're saying, strictly speaking, this is not profit, this is contribution, because we're only bringing in our marginal cost. So how do I calculate contribution? Well, pretty straightforward really. Selling price less marginal cost, also known obviously as variable cost. Okay, so let's just say I had a unit, 1 unit of one product. I take the selling price, take off the marginal cost. I have the contribution per unit. What about total contribution? Well, simple enough. Total number of units sold times contribution per unit. Now, let's link that to an important area, fixed costs or fixed overheads, sometimes referred to as period costs. Now, we know from our past studies, and indeed perhaps even from your study of the chapter, that the difference between fixed costs and variable costs is fixed are probably larger. They don't vary with production, and indeed they're related to items that are probably fairly significant. So note that we take fixed costs as period costs when marginal costing is used. Now, what exactly do we mean by that? Well, we mean a period. We mean 1 month. We mean 1 quarter. We mean 1 year. We, broadly speaking, expense those fixed costs in that period. They don't get carried over in any way, and as it says right in the end, they're not related to production levels. I can produce 50, 5,000, 1 million. At the end of the day, those period costs or those fixed overheads are charged to that month. They're charged to that quarter. They're charged to that year. Now, in terms of scenarios, given what we've said so far, i.e. we defined contribution, we said selling price less marginal cost, we looked at period or fixed costs. What are the possible scenarios that we might be faced with in the exam? You'll see I've just cut and pasted from the study up. So let's look at point A. So we've got a scenario where contribution is less than fixed cost. Now, clearly on a profit and loss basis, that must be a loss. It has to be a loss. So losses are incurred as contribution was insufficient to cover the fixed costs. So you can see the relationship there between this area of contribution and indeed fixed or period costs. Point B, let's say contribution is equal to fixed costs. Note that we're referring in terms of the points to the diagram. I haven't reproduced the diagram here just because of space and indeed time. We're trying to get through the areas as quickly as we can. Now, on that basis, we have a break even. We must have a break even. It's equal to fixed costs, so we haven't got a profit and we certainly don't have a loss either. Point C, as you'll see if you refer to the diagram after this video, is contribution in excess of fixed costs. On that basis, we have a profit. We must have a profit. Outside of that, in terms of understanding this area, I think what we've got to get a fix on here is this sort of set of formulas You know, the idea, for example, that, excuse me, the contribution is equal to X minus Y, selling price less marginal costs. The idea that at a break-even, contribution is equal to fixed costs, because this is what the examiner is going to target, your understanding of these formulas. And he's going to put you in a position where, let's say, you don't have a number, X, and you need to find it. So you need to be able to manipulate other numbers, okay? Let's move on from there. Let's talk firstly about marginal costing. Now, let's not get overexcited. All we're talking about here is a way to cost a product. We're a company of manufacturers. We manufacture product A. We can choose the costing method. We can choose marginal costing. We can choose absorption costing. It's up to us. You know, it's up to us to decide which is more appropriate. At the end of the day, the costing method should give us the most accurate cost. And this, again, is the type of thing that the examiner will target. You know, what's the difference between marginal costing and indeed absorption costing, which is better in this situation, etc. So when we think about fixed costs with the marginal costing approach, as we've said, the expenses or the fixed costs charged against profit for the period. So it expenses fixed cost in that period, in that month, in that quarter, in that year. And in addition, and this is the first time that we've mentioned this, this is important, it does not retain any fixed costs in inventory. I'm talking about in closing inventory, unlike what we'll see below, which is absorption costing, which does build in fixed costs into inventory valuations. Let's take a look at absorption costing. So clearly, fixed costs allocated, apportioned, and absorbed in some way, shape, or form using an absorption rate into inventory. I'm talking about stock, I'm talking about raw materials, I'm talking about finished goods, etc. Now note, given that any unsold inventory, we get to the end of the period, if we have inventory, obviously we've absorbed fixed cost into it, then this unsold inventory would carry a proportion of fixed costs into the next period. Note how that's different to marginal costing, because fixed costs or period costs with marginal cost, they're expensed in that month. I'm not carrying them into the next month or the next quarter. No, no, no. So given that, let's move on to the variable cost area, i.e. the idea that only variable costs are relevant. So first things first, I mean, clearly, excuse me, only variable or marginal costs are included in inventory valuation, yeah, unit by unit. Now, what will that include? You know, what type of costs are we talking about? Well, we're talking about what is generally referred to as the prime costs. You know, in one sense, the sort of more important costs: direct materials, 2 kg, direct labor, 3 hours, direct expenses, variable production overheads. Those four main areas are our variable or marginal costs. Okay? Let's look into inventory valuation, given what we've said now. There's several areas here that we'll see the clear difference between these two methods. Now, on the basis that we've said that marginal costing will basically expense fixed costs, and indeed that absorption costing will build in, using some sort of absorption overhead rate, fixed costs into inventory, they have to produce different profit figures. They have to, because they've got different closing inventory figures. So looking at the diagram that I've cut and pasted here, if I just bring this across a little bit. Let's look at the left-hand side first. And again, now I'm repeating myself, but no harm in doing that. When we think, firstly, the first area, valuation of production of, like, say, finished goods. Absorption costing, all production costs, including production overheads. Marginal costing, variable production costs only. Remember, prime costs. Note, fixed production overheads not included. Okay? Second area, again, repetition, treatment of fixed production overheads. Under absorption costing, absorbing costs, absolutely, including the value of fixed goods. Marginal costing, expensed for the period, in that period, month, quarter, etc. Third area, relationship with the selling price. Okay, selling price less absorption cost equals profit, as you would expect. Note with marginal costing, selling price less marginal cost equals contribution, not profit. Okay, let's be careful here. Easy to make a mistake. In terms of the description, broadly speaking, under absorption costing, total cost of production, certainly it helps to set the selling price. Because think about it, we are including really every cost that we have in some way, shape, or form to cover all production costs. Moving across to marginal costing, it's the costs really of making one additional unit. Certainly useful for decision making in that incremental sense, okay? But as we know, does not bring in this whole area of fixed production costs. Let's just move this down a little bit. Okay, inventory valuation. Now, again, we're repeating ourselves a little bit, but no harm. So an absorption costing cost card, okay? As you can see, yeah, all of the main elements that you would expect there, i.e. the prime costs, but right down at the bottom, fixed production overheads, giving us our total unit cost under absorption costing. If we move it down a little bit further, 1 second, marginal costing, again, exactly what we expect. All the prime costs, but note, no fixed production overheads, okay? Now, just take a quick look at the note there. The total cost of a unit of finished goods under absorption costing will always be higher than on marginal costing. It has to be for the reasons that we've described, okay? Now, a couple of other points here that are relevant in terms of just like honing in on the sort of profit differences, I guess. So, bottom line is, what's affected? Well, clearly two main things are affected with the choice between these two methods. I mean, the opening inventory must be affected because last year we valued using, let's say, absorption costing or marginal costing, and indeed over and above that, the closing inventory must be affected. So those two things have to be affected by the choice, absolutely. Now, in terms of a statement of profit and loss account, let me just move this across to make it easier for you to see, depending upon what you're watching this video on. Bear with me 1 second. So here's a sort of what you might call a sort of an extract, okay? So again, we're talking about absorption costing. We're talking about the full note statement of profit and loss account. When I say full, obviously I'm talking about everything excluding, let's say, indirect expenses, stationary motor expenses, etc. So it's sort of what we would expect, I think. We see sales revenue. We clearly see cost of sales encompassing opening inventory, production costs, closing inventory being taken off. We have the production cost of sales. We have gross profit being the difference between that figure and sales, and let's take off non-production overheads to give absorption profit, okay? Now, contrast that with the marginal costing statement. Now, again, quite a lot of information for you to take in. You will have been through the chapter. I'm hoping that you focused in on doing the activities. Remember, there's no hiding place for getting the questions wrong, learning from failure. Please remember that. Now, marginal costing, statement of profit and loss account, again, sort of what we expect to see. We see sales revenue. We see cost of sales, as you'd expect, opening inventory, variable production cost, closing inventory. Note, we see a variable production cost of sales, and we see variable non-production costs being deducted, in other words, all variable costs, giving us our contribution. And then below the line, we see these fixed production costs and fixed non-production costs. So you can see clearly the differences. If I get them both on screen at the same time, you can see clearly the differences between the calculation of absorption profit versus the calculation of marginal profit. Now again, would I suggest you literally learn that now, those formats, those performers? No, I wouldn't. But think about them now. And indeed, when we're doing the questions, OT questions, and if you're watching my OT summaries of the questions, my walkthroughs, fix in on questions on this area: absorption costing, marginal costing. This is important, and try and get a fix on the difference between the two. Now, in terms of a summary, just before we get to the sort of last main branch, we're saying that the two profit figures are going to be different. I think we know why, because of the inventory, okay? So if we were to think of, well, okay, what if we got a question that pertains to reconciling them, yeah? How would you go from one to the other? Well, there is a way of doing that, okay? Let's note, first off, key point, as I said up top, that certainly different profits will be reported linked into the change in the number of units between opening and indeed closing inventory. I'll open up that point a little bit more as we go down the page. Now, in terms of a reconciliation, yeah, if we were trying to move from, let's say, marginal profit to absorption profit, what's the difference? Well, as you can see here, and as I've touched on up top, is marginal profit really is the same as absorption profit, with allowing for or excluding, I guess, the absorption of overhead into closing and indeed opening inventory, or the difference between closing and opening inventory. Okay? Now, that may lose a little bit in translation. You may look at that form and say, what are you talking about? Okay, we need to do questions. Now, let me give you some scenarios. Okay, let me give you some examples of the types of things that we may see in an exam. Now, if we know this rule, we might get closer to an answer. So if we're trying to determine whether or not absorption or marginal cost profit will be higher, then certainly if we look at opening v closing inventory, if they're exactly the same, yeah, if there's no change in inventory, then really we're not going to have any change, note, between absorption costing profit and marginal costing profit. There's no change at all. Remember what we said, the difference in opening and closing stock, yeah, or opening and closing inventory is what creates the difference in the end profit. If we have opening greater than closing, certainly the the absorption costing profit will be less than the marginal costing profit, because closing stock is coming down, okay, in comparison to opening stock. If we have opening stock less than closing stock, the reverse would be the case. Absorption costing profit greater than marginal cost. Now, we need to work the questions for this to drop. Just reading or indeed listening to me talking, I appreciate. That sounds great, Paul, but what the hell are you talking about? Let's work the questions. Now, in terms of advantages, let me just get to the right point here. As I said really from the off, companies have the option to choose the absorption or marginal costing method. It's not written in stone. It's not in Companies Act. You have to do this or you have to do that. So they need to decide what suits them. Let's look at absorption costing first and just think about the main advantages, as it were. Okay, so looking on the left-hand side of advantages, in terms of IAS2, the standard, it does require some fixed production overheads to be included in inventory valuations, or it prefers that. Okay, that's the standard. Does that mean you have to do it? Not necessarily. Okay. Outside of that, if we're using absorption costing, if we're absorbing overhead into inventory valuation, to some extent, it may help us to control costs better, because we can analyze the fact that really we're building in to production or linking to production our fixed costs. So it may encourage us to control costs better rather than just expense those fixed costs in the year. They're not related to production levels, etc. Okay. Third key advantage is, broadly speaking, and again, this is subjective, you may say that absorption costing is better because you're considering all costs. You're considering all costs that you're incurring, and you're building them in or linking them in to what you're actually producing. So in one sense, you could sort of gauge forward or forecast forward, say, well, we're going to be producing 10,000. We know that we should be able to absorb all our overheads into, let's say, 10,000 or maybe 12,000, okay? With marginal costing, you don't have that upside. What about disadvantages of absorption costing? Well, it is a little bit more complicated, isn't it? So rather than simply expense fixed costs in a period, our fixed costs are 50,000, bang, January, done, okay? You've got to calculate a rate, an absorption rate, yeah? And you may end up in some way, shape, or form either under absorbing or over absorbing overheads, at the end of the period, okay? Outside of that, there is a suggestion, although again this is subjective, second one, there's a limited use in the decision-making process, because you're considering things that you can't do anything about. For example, your fixed costs are your fixed costs. Maybe you can do something about your variable costs. Maybe you can change your supplier or reduce the quality of your materials, etc. Your fixed costs are, your rent, your overhead, your electricity, your supervision wages, etc., etc. So realistically, why build some of those in to your production levels? What about the advantages and disadvantages of marginal costing? Again, we need to know these. Left-hand side, advantages. It's easy to use because it's only based on prime costs. I produce one extra unit. I know that these areas, materials, labor, variable production, they're going into that unit. That's it. Okay. Linked into that, I think that short-term decision-making is probably more easily facilitated using marginal costing. Excuse me. Third key point, there's no need for any consideration of under-absorbing or over-absorbing fixed overheads. Outside of that, number 4, the contribution is a key number, isn't it? Because then we can link it to fixed costs for the period. So it actually makes contribution per unit easy to calculate and easy to figure out total contribution as well. Okay. Outside of that, just a final reference to the mechanics, i.e. fixed overhead treated as period costs. You could call that an advantage. You could also call it a disadvantage, as we sort of alluded to up top. In terms of disadvantages, we certainly need to reconcile profits with absorption costing profits because we're not accounting for fixed costs. So that takes time. At the end of the day, in relation to IS2, our standard is not compliant because it's not bringing in production overhead. And then final point, it doesn't include all costs. We have some production costs that are just expensed in the period. So again, common sense point, but we could suggest, well, you're not being realistic. If it's a production cost, it's a production cost. Include it in your unit costs. Okay, so that really concludes this particular chapter. Fairly short one for us, but again, as I've said, this is an important chapter because I think of the little trickiness in the calculations. This is an examiner's favorite topic. This is up there in my top out of all the chapters in MA. I would say this is up there in my top 8 or 9 for sure. Absolutely. So, if you're not sort of working in management accounting, if you're not keen on management accounting, or maybe you're just not keen on numbers, you like the more discursive or narrative areas, I get that. I would probably be a little bit like that myself. But don't avoid this chapter just because you find the questions difficult or just because you find the questions unpleasant. These questions on this area are coming up in your exam, absolutely, categorically. Okay, I hope that all made sense, that your studies are going well at this early stage. Keep on trucking. Many thanks.